Okay, so welcome back. Last time we got up to the point where we talked about how Phelps suggested that there could be inefficiencies generated by a government having to rely solely on direct taxation, suggesting it might actually be optimal to have inflation above, well, that negative rate of inflation that's equal to the real rate of interest. So really the question is, how does inflation generate revenue for the government? Well, inflation generates revenue for the government through something called seigniorage. Now, if we want to look at the central bank's budget constraint, so let's say ST is equal to the budget constraint, it's the flow of money, right? So this 1 plus pi times MT plus 1 minus MT, what that is that's basically money creation, right? It's the addition of new money into the money supply. And then we've got this minus RCBT, right? So this flow of money, this creation of new money into the money supply is technically referred to as seigniorage. RCB are receipts from the central bank, hence RCB. Now, the central bank's profits are given to the fiscal authority. So the Federal Reserve in the United States, for example, operates kind of as like a private bank, right? And it does generate profits. And when it does generate profits, those profits are then transferred back to the Treasury. Now, if we consider the fiscal authority's budget constraint, we have this. So this is the quote-unquote government budget constraint, which is equal to tau, which are taxes, plus the flow of bonds, or the addition of new bonds into the market, right? So this BT plus 1 minus BT, that's the flow of new bonds, or the flow of bonds, hence the creation of new bonds being added into the private market. Basically, they're borrowing, right? But we get this plus ST, which is the central bank's budget constraint, plus receipts from the central bank. Now, the fiscal authority just directly taxes and borrows. That's all it can do. And it earns receipts from the central bank, right? Basically, the central bank's profits. But if we combine the central bank's budget constraint and the government's budget constraint, well, we get this, right? So everything in pink is the government's budget constraint. Everything in blue is the monetary authority, or the central bank's budget constraint. But if we look, right, in equation 66, well, I have a minus RCB and a plus RCB. So these receipts cancel out, which gives us just this, right? So the government's budget constraint now is a function of taxes, the creation of new bonds, borrowing, and then the creation of new money. So instead of just having two sources of revenue, taxation and borrowing, there's now a third form of revenue, which is the creation of money, seigniorage. So if the central bank wants to print more money, well, they definitely can, and it helps the government finance stuff. But it does actually even more than that, because it doesn't just help them finance stuff today, but it can also reduce the value of the debt the government owes over, some longer time horizon. If we let the debt that the government owes be defined as, like, say, D sub T equals this flow of bonds, right, this creation of new debt, well, if you remember the Fisher equation, right, would sort of imply this identity here. If I were to plug that 1 plus inflation over 1 plus the nominal rate in for 1 over 1 plus the real interest rate, then if I were to increase inflation, but holding the real or the nominal interest rate constant, what happens is kind of the real interest rate has to fall. Now, it says in nominal terms, what I really meant was in real terms, so it's a mistake on my part. In real terms, the value of the debt the government has to pay back falls. In nominal terms, it doesn't fall. All right, if you borrow, say, $1 trillion, well, you have to pay back $1 trillion. But if you inflate that $1 trillion out a little bit, in real terms, you're actually paying less than $1 trillion. Kind of weird, isn't it? Well, it's kind of what happens here is that we can see inflation actually helps borrowers, but it can kind of screw lenders over. This is what's known as monetizing the debt. If the debt gets monetized, basically, let's say the government has a hard time paying its debts, they could monetize the debt by just inflating it away. Well, actually, maybe not, because it really only kind of works in very small doses. If we overuse it, well, we end up with a situation like this, where we've got this massive wheelbarrow full of cash, probably to buy something that is, like, extremely cheap, like, a loaf of bread or something like that. When you get runaway inflation, you end up in situations like this. This is what's known as hyperinflation. Hyperinflation's really, really bad, by the way. It's like extremely bad. It happened in Germany after World War I when they decided to try to inflate away some of their debt, and there ended up being that, quote, wheelbarrow of Deutschmarks to purchase a loaf of bread. And it's happened all over the world. It's happened in sub-Saharan Africa. It's happened in Venezuela. It's a really bad monetary situation to find oneself in, and it generally leads to a collapse in the currency. Not good stuff. Now, there's a couple of theories at the price level regarding basically how monetary and fiscal policy can operate, right? Because what you saw with the budget constraint for the fiscal authority and the budget constraint for the monetary authority, right? They interact, but that kind of leads to two different theories of the price level in terms of how these two guys interact, right? Because they interact in different ways, it's going to be changing the price level, which hence changes the rate of inflation. Now, there's monetary policy dominance, where basically fiscal policy is just assumed to adjust to ensure that the government's intertemporal budget constraint is always satisfied. Now, what this means is that even though the government may not have a balanced budget is government spending equals taxes. They may have to borrow. But if they borrow, well, they borrow, and that's what they spend. So, technically speaking, the government's budget constraint is always, always, always satisfied. It's never not satisfied. So, when we look at that, it's like, okay, wait a minute, haven't people said that that's not true? Yeah. Austrians will laugh at stuff like that. They'll be like, oh, that's stupid. How could you say the government's budget constraint satisfied? It's like, well, because it is. You can look at the math and see that it is. But then again, not everybody understands dynamic macro, or really a better way to put it, not everybody cares to learn dynamic macro. So fiscal policy basically adjusts just to ensure that their budget constraint is satisfied, absent any sort of influence from monetary policy, because monetary policy is independent here. It's free to set the nominal money stock or the nominal rate of interest to whatever they would like it to be, right? So what does that mean? Well, it means basically the fiscal authority kind of does their thing. They kind of have to make sure that their budget constraint is satisfied, and monetary policy can do as it pleases by either setting the nominal money stock or the nominal rate of interest. Now, in the U.S., it was typically the nominal interest rate that was being set until we hit the financial crisis of 2007, 2008. Quantitative easing came in. Things changed. We'll be talking about this, by the way. I don't think this is the only time that it'll really be mentioned. They kind of shifted their attention from an interest rate over to the quantity of reserves or excess reserves that financial institutions were holding. So they kind of switched from the nominal interest rate over to sort of like a nominal money stock, right? They were controlling the money base. Now, in short, what this means here under monetary policy dominance is that fiscal policy is passive and monetary policy is active. So this is how fiscal and monetary policy works in the United States, right? The fiscal authority kind of moves first. They have to set everything to balance their budget constraint. Then monetary policy can do as they please afterwards, right? And they're under no real requirement to help the federal government or to help Congress try to balance their budget in any sort of way, right? Congress can't just go, oh, well, hey, you know what? We want you to inflate at this rate because, well, we say so, right? The central bank can literally just throw up two middle fingers and be like, go F yourselves. So central bank's independent of the fiscal authority. Now, they're not fully independent because, remember, they do have that dual mandate, right? They're basically their mandate to control, to try to minimize unemployment while maintaining an inflation rate of about 2%. Now, this is kind of where, like, you can hear the terms like inflation hawk and inflation dove. That's kind of where this comes into play. An inflation dove, right, if the dual mandate is to control, is to try to use monetary policy to minimize unemployment and at the same time stabilize inflation, keep it around a 2% rate, an inflation dove would be a little bit more willing to go above that 2% target rate of inflation if it means reducing unemployment, right? If we're in, say, a really nasty recession, for example, the central bank might actually be willing to go above their target rate of 2% per year if it means reducing unemployment to a more acceptable level. We've seen inflation doves in our lifetime, right? Janet Yellen is an excellent example of an inflation dove. She was very, very, very dovish on inflation because, well, she also found herself in a pretty nasty situation, right? So some of these dovish or hawkish policies can kind of sort of depend. They can be state dependent, right? The state of the economy will sort of determine whether there is more dovish or more hawkish policy in the United States with, well, monetary measures. Janet Yellen was very dovish on inflation, though. All right, we've also seen inflation hawks. For example, Paul Volcker, the chairman of the Federal Reserve when Ronald Reagan assumed office, was very hawkish on inflation. He basically had the opposite view that Janet Yellen did. Basically, keep inflation low, and, well, the hell with the unemployment rate right now, because if we can stabilize prices and we can sort of keep the inflation rate stabilized, right, we can minimize it, let it achieve like a certain desired rate of inflation, then that will reduce policy uncertainty in the United States, and that can actually help sort of spur economic growth as well. So there's two competing arguments. Now, granted, like I said, there's state dependence, because Janet Yellen found herself in the middle of a really, really nasty, very slow economic recovery that took, the better part of 10 years to actually reach the same level of GDP that we were at prior to the collapse of 2007, 2008. Meanwhile, Paul Volcker found himself in a situation where there was extremely high unemployment, but also extremely high inflation, and you couldn't really use increases in inflation to try to reduce unemployment anymore. So he vastly tightened the money supply in order to try to reduce inflation to get it back down to a more acceptable rate, which did cause the unemployment rate to spike for a while, but eventually it stabilized, and you actually, really, after that, it's sort of what's referred to as the Great Moderation. But anyways, I'm going off on a tangent here. I'm trying not to do that. My Vyvanse wore off like a couple hours ago. There's fiscal policy dominance. Now, when there's fiscal policy dominance, or the fiscal theory of the price level, the fiscal authority sets its expenditures and taxes without any regard to any requirement of the intertemporal budget balance. The value of these taxes is not sufficient to finance expenditures. Seigniorage has to adjust to ensure the government's intertemporal budget constraint gets satisfied. Now, there are... thank God my throat's not very clear right now, as I get to clear my throat, and it's not done for dramatic effect right now. Well, maybe it's sort of done for dramatic effect, but it also served a purpose of clearing my throat. There are certain members of Congress, we'll say, certain what used to be called fresh faces of Congress. So fresh, fresh faces. Well, these fresh faces, or I think they're kind of called now the squad, advocate rather high spending proposals. Now, some of these spending proposals, do some kind of decent things, right? Ensure Medicare for all. Well, nobody's really going to be against ensuring, ease of access for most, if not all, people in the United States to health care, right? It's kind of not okay to be like, you know what, screw sick people. If you're sick and poor, go die on the streets, right? No one's really going to be saying that. So, okay, well-intentioned idea. No one's really going to argue that, we should try to do something to ensure that people can get easy access to health care, right? The method through which we do it is up for debate. But the fact that that's the end goal, I don't think anybody really debates that. Ensure a job guarantee for everyone, like a federal job guarantee. Hey, you lost your job in the private sector. Well, screw it. The federal government will just hire you. Yeah, that's going to work out well. Eliminate cow farts to protect the environment. Yep. I shit you not. No pun intended there. That one's actually true. I swear to God. Sorry, that sniffle was brought to you by neither COVID nor cocaine. It was brought to you most likely by a change in seasons, or, I don't know, 4 cats running around, pissing me the F off, trying to get into this little box of treats that I reserved for Isis while she's getting her treatments, because these shots are huge. Maybe I'll upload a picture sometime if you guys want to see it. Not of me injecting her. That would be, kind of mean. That's borderline animal abuse. But just the shot itself, the syringe is massive. She's got to get 2.5 milliliters of this stuff that's thicker than Caro syrup. She needs this massive needle to get it to actually go through. And the stuff is acidic. And would you stop chewing on that? No. Anyways, The stuff's pretty acidic, and so it stings, and it kind of like, burns a little bit as it goes in. And it doesn't make you feel very good giving her that. And she gets mad, looks at me, kind of gives me that, like, Dad, why does this hurt, Dad? And then she basically yells at me, just meh, gives me the business for a couple of seconds. So I give her treats, like, hey, thanks for being a good sport. Here, have a treat. Anyways, yeah, so they're trying to get into that, and it's kind of pissing me off. But, okay, they want to retrofit existing buildings to be environmentally friendly. Well, to some extent, you can't really, knock them for wanting to care for the environment. I mean, we like to try to maintain some level of environmental quality in the United States. But they also want to do things like get rid of fossil fuel usage. Like, yeah, that's going to work, except, it's not. Eventually it will, because, we'll kind of run out. And before we run out, I would like to think that there would be technological innovation that sort of reduces our dependence on fossil fuel usage. But that dependence isn't going to be reduced by government decree. It's going to be reduced by innovations within the market itself. And that's not an ideological thing. That's just kind of a fact of life. Now, in case you haven't figured out who I'm talking about, it is, drum roll please, Alexandria Ocasio-Cortez. Yeah. Or as some of my Democratic friends have told me, AOC apparently stands for always on camera. Yeah. Drum roll. AOC. AOC +3, the squad. Now, her plan's wildly expensive. And it can't just be afforded via things like, traditional means of financing it, like basically under the monetary policy dominance, right? So she and other far-left economic people advocate a certain theory of monetary policy. It's called modern monetary policy, or MMT. Now, before I go further, right, because I don't want to give this impression that I have this, like, absolute disdain for, the far left, where I'm like super far right or anything like that. I'm not super far right, nor am I super far left. I consider myself somewhat in the middle. I think generally markets are the best solution to reaching a desired allocation. ISIS, get away from that. Come on, stop. To achieving a desired allocation of resources. There are times where there are market failures, and then governments have to step in to try to manage that. So I'm neither far left nor far right. I advocate neither far left nor far right economic policies. I just kind of want that I want that point to be made. I want that point to be easily understood by everybody. And I also want to say that while I do have my personal political views, I mean, everyone's got their own set of political views, it's not my job to share them with you, right? I've discussed my economic views, but those aren't really my political views. It's not my job to indoctrinate you with any particular economic or even political views whatsoever. It's not my job to go, oh, well, you should believe, that this is better than that. Now, I will flat out say that there are certain theories that are just pure trash. That's not because of any political bias. Whether I was left or right-leaning, I would still tell you that modern monetary theory, or MMT, is just pure trash. Just like I would tell you that, advocating a gold standard, wanting to go to a gold standard where the central bank really didn't do anything at all, and the value of the dollar is based on just gold, well, that's also a trash theory. And if you guys are interested in that, shoot me an email. I'll definitely make a video explaining how the gold standard is kind of a bad idea. But anyways, yeah, moving on. So there are theories on both sides that are just pure trash, and I have no qualms about saying that they're pure trash. Now, under MMT, the idea is the following. If the government can issue its own currency, right, which, technically speaking, it's true in the United States, then theoretically they could just use seigniorage to pay for its projects, which means that it advocates fiscal dominance of the price level, or the fiscal theory of the price level. Thus, the fiscal authority takes an active role, and the monetary authority takes a passive role. Now, you might ask, okay, how in the hell does this even work? I'm glad you asked. I would answer by saying it works like this. Congress sets a spending bill, or whatever amount that they want. Now, the central bank has to print the money to fund the bill. Sounds like I got an email from somebody. The central bank has to print the money to fund the bill, and then they give that money to Congress. Congress spends it as they wish, thereby removing any independence of the central bank and giving Congress no incentive to minimize cost. It's kind of a problem. Because actually, like when I was talking about Paul Volcker, trying to cut the money supply and all that. Well, before even Volcker took office as the Fed chairman, or I guess we should say Fed chairperson, since we have now had both men and women as presidents of the Federal Reserve Bank, or chair people of the Federal Reserve Bank, I should say, not president. Well, before Volcker even, right, there was kind of this time where it was sort of assumed that Congress would try to manage the price level. It didn't work out very well. Hint, hint, hint. We actually kind of ended up with double-digit inflation while they were trying to do that, because it's kind of a bad idea to let Congress try to manage the price level. But don't tell these people. Let them find out on their own through their own research. Basically, it flips the roles of the fiscal and monetary authorities around. Now, before modern monetary theory, because modern monetary theory is not in practice right now. I don't want you to think that it is. It's not. We do not have modern monetary theory in the United States, nor will we ever. But if we were to go to modern monetary theory, before, you would have the fiscal authority balancing the budget, monetary authority balancing the price level. Under modern monetary theory, MMT, what would happen is the opposite. The monetary authority balances the budget, and the fiscal authority balances the price level. Basically meaning what happens is the fiscal authority takes a more active role, and the monetary authority takes a more passive role. Not a very good idea. Because, well, if this happens, how do we ensure inflation is under control, that we keep inflation under control? Well, fear not, because the fiscal authority will fix all that for you by setting taxes to just make sure they can pull all that excess money out of circulation and just send it right back to the government. Oh, yeah, because that'll make perfect sense. Yeah, that'll totally work. I have no questions about how that'll work in any proper way whatsoever. Tax evasion. Also, because there would be more reserves being printed than before, the central bank would still use their open market operations to purchase or sell bonds to maintain reserve requirements held by central banks. Right? So it's kind of a screwed up way of thinking about how sound it out, Jeremy, how monetary policy should be operating in conjunction with fiscal policy. It's kind of a good idea to keep the two separated, right? For very, very, very obvious reasons. Now, under this notion, we don't just give the power of the purse to Congress, right? As I'm sure you've heard, House Speaker Nancy Pelosi, every single time Donald Trump does something that pisses her off, she always goes on about how the Congress has the power of the purse and the executive doesn't, right? The power of the purse goes to the legislative branch. So the legislative would have the power of the purse, but under modern monetary theory, they would also get the power of monetary policy. So when they can dictate how much the central bank can print and how much money can circulate in the economy, they're kind of controlling interest rates, are they not? Meaning the central bank kind of just becomes the national bank of mom. Like when we go to college, like when I went to college and I was hungry and broke, I'd give mom a call, and the national bank of mom would, make a nice little hefty deposit into my account. And basically the central bank just becomes the same thing, right? They kind of just get forced by the legislative branch to just sort of give them money whenever they want it, which isn't a particularly good idea. Because if you do that, right, if we operate under MMT, what happens is you give the power of monetary policy to these clowns. All right, now, I think they have like an approval rating somewhere in like the 20 or 30%. Do you want people that have a public approval rating of like 20 to 30%? Most of these people are idiots, by the way. And I'm not saying this like either in I know more about whatever than they do. They probably have a much better understanding about how government operates than I do because, they're working in the government and I am not. Nor am I saying that it's a party line thing. Oh, all the Democrats are stupid, or the Republicans are geniuses, or, those dumbass Republicans or the Democrats are geniuses. I'm not saying either one. They're both pretty stupid. Now, you have very intelligent ones on either side of the aisle. Steny Hoyer, for example, is a very, very, very intelligent Democrat. And I actually respect Steny Hoyer quite a bit because he is one of the main advocates for maintaining central bank independence. So I don't want you to think that this MMT thing is sort of accepted by all Democrats. There are a lot of Democrats that think MMT is a very, very bad idea, and they are very correct to think so. On the other hand, you also have very intelligent Republicans in Congress. There are intelligent people on both sides. And those intelligent people tend to be relatively bipartisan and work with each other, talk with each other, all that stuff, right? So I have faith in some people in Congress, but as a whole, I don't have much faith in Congress, right? They can't even balance their own budget. Now, they can satisfy their intertemporal budget constraint, yes. That much is kind of, guaranteed by, default, I guess. No pun intended on defaulting on the national debt, by the way. But just because they sort of just by chance happen to get the budget constraint satisfied every period doesn't mean that they're like geniuses at economic policy. They're not. Most of them are lawyers by trade. Do you really want a bunch of lawyers setting economic policy? Because I don't. I would much rather have, the Federal Open Market Committee setting monetary policy, because when they do that, at least we have the guarantee that we have very well-trained macroeconomists who are very experienced macroeconomists. I mean, look at Ben Bernanke, look at Janet Yellen, very, very, very experienced monetary economists. All right, Ben Bernanke was published in tons of very high-ranked academic journals, right? He had more than established his credentials as a macroeconomist before he was appointed to the Federal Open Market Committee by Bush in, I think it was 2006, 2005, something like that. And he eventually rose to prominence very quickly. And by I think it was 2007 or so, or maybe it's 2006, when Alan Greenspan retired, he became the chairman of the Federal Open Market Committee. And he did a very good job. And he had some very dovish policies on inflation. A lot of Republicans love to hate the guy, and I don't really understand why, because as we'll talk about later, he actually had a pretty saving the U.S. economy and ultimately the global economy from a much worse recession than what it eventually experienced. Now, I'm getting ahead of myself, but again, I'm going off on tangents because my Vyvanse wore off a little while ago. I don't want to give the power of monetary policy to 535 mostly trained lawyers. They might have some good ideas on how to pass laws. They probably know a lot more about passing laws than I ever will. They've probably forgotten more about passing laws than I'll ever know. But that's fine. It's great for passing laws. It's not really very good for passing stuff like with monetary policy. Not to mention, imagine how long it would take to set monetary policy. Right? In 2007, 2008, the Federal Reserve responded within hours of things getting really bad. Right? After the COVID breakout earlier this year, the Federal Reserve responded within a day of things getting really bad. Could you imagine getting these people to come to an agreement in a matter of hours or under a day on monetary policy measures? Because I can't see that happening. I can see them arguing for months and months and months on what monetary policy needs to be, and meanwhile the economy has already tanked and probably already begun to recover by the time they decide to lower interest rates, and it just doesn't work out very well in that case. Now, modern monetary theory does have some serious proponents who can be taken seriously, sort of. For example, Stephanie Kelton at SUNY Stony Brook actually worked under Bernie Sanders' campaign in 2016, and she loves the idea of modern monetary theory. A lot of people do see it as a panacea for public spending to help reduce inequality. And I've heard rather substantial arguments for how it can reduce income inequality and wealth inequality, but the problem is there are so many concerns that exist with modern monetary theory that these concerns and the possibility of these concerns becoming reality is much greater than the probability of this actually reducing inequality. Therefore, while it's a compelling argument, it doesn't actually compel me to buy into modern monetary theory. A lot of other people will argue it's sort of a foolproof method to relax the government's budget constraint in a feasible way. Well, again, I've heard arguments. They're not very good arguments. So it's actually, it's really not that good because it falls short in a number of areas. It doesn't consider, for example, the risk of capital flight. So what is capital flight? Well, capital flight happens when stuff like, excess regulation, capital controls, tax burdens, currency devaluation, and political or economic instability basically induce investors to just take their financial assets and leave. It's you know what? F it. I'm going to pack up my shit and leave. I'm getting out of here. And sometimes it's legal, sometimes it's not very legal. And again, this isn't trying to say that, all this stuff is good or bad. It's just these are conditions that can induce investors to take their financial assets abroad. Just it is what it is. These things happen. Sort of another fact of life. Now, if the U.S., for example, was the only currency operating under MMT and it didn't work out very well, then you'd likely see a huge surge in capital flight to other economies. On the other hand, if everyone used MMT, then there'd be an incentive for at least one economy to deviate from the plan and have huge capital inflows into their country at the expense of all the other countries. So that wraps up this lecture. So there were, 3 lectures in total. Each one's about, between 30 and 45, 50 minutes, something like that. I hope you enjoyed the lecture. I hope you enjoyed that there was a little bit more intuition here than there was just pure math. We're kind of going more down this direction rather than just pure math now. I did have you guys do a lot of math at the beginning, but the math was really to get a little more. So I know it sounds strange, and I know you probably don't believe me yet, but really the focus of this course is going to be more on intuition than math. I care more about how you can explain the math than how you can do the math, so to speak. I thought it would be cool to kind of go through, talk about a heterodox school of thought when it comes to monetary policy. And Isis, get away from there. Come on, no ma'am. I don't care if you're sick. Get away from there. I thought it would be interesting. I thought it'd be kind of fun to talk about this stuff. And I hope you enjoyed it. I hope you enjoyed this nice little detour that I took where we talked about, more heterodox schools of thought. So in the meantime, just sort of be on the lookout for another lecture that's coming sort of soon, where we're going to look at static graphs and responses of these static graphs to different types of economic shocks, where I will actually be illustrating what monetary neutrality and monetary superneutrality actually mean. So that will be coming up in the next couple of days, so be on the lookout. And until then, enjoy yourselves, and thank you for watching. Oh, and by the way, I guess I did make some kind of a promise here that I would be showing you what the end of, or what the main riff of that song was. That was a cover. Let's see, where do we go here? Well, I guess you kind of figured it out. It's Livin' La Vida Loca. There aren't any vocals yet. There will be eventually, but kind of have to wait on somebody to show up and do the screaming stuff. Okay, well that's probably enough.